Good morning, folks, and welcome to the Pre-Market Insight for March 9th, 2020. We are experiencing historic price action. Let's take a look at the charts. We're looking at a chart of the S&P 500, and currently we're down just about 4.9%, 145 points on the futures, and we are locked limit down, which means that we are no longer able to go beneath that number until the regular trading session starts. And it has been that way since about, I would say, 8 or 9 p.m. Last evening, a couple of hours after the futures opened, after digesting a slew of negative news pertaining to the coronavirus, pertaining to the now what seems to be an all-out oil war between the major oil producers that sent oil sliding 20%, which we're going to have a lot of negative ramifications still yet to be considered and fully priced in. And so today is the first day in several years that we've had this phenomenon occur, and definitely the first time since 2016 when we had a change in the US presidency and a change in the price action. So we're looking at the 15-year quarterly chart, and I zoomed all the way out to the quarterly chart just so you can see the extent of the bullish trend that we've had. And for the last several months, I've been highlighting the fact that for the last 2 years, between 18 and 19, we were essentially in one big broadening formation, i.e., even though we were clearly in an uptrend long-term in the long-term chart, in the short-term chart, we were actually range-bound. Although we had a 30% year last year in the S&P, the Nasdaq, and about 25% in the Dow, we actually on the S&P simply regained the losses that we shed in 2018. And so although we had that big bounce, all it did was take us back essentially to the end of 2017, to the beginning of 2018. And so this very nice push that we had to start off the year, again, creating hypotheses for what is probable, knowing that anything is possible. We spoke about the fact that on the shorter term chart, we had a possible distribution candle, which simply means that there was selling coming in at highs. Now this happened, if we go down to the weekly chart, this happened right here at 33.26. We spoke about the fact that these two candles could portend signs of selling at the highs and would need to be confirmed in the next month. And it so happened that we came up with a very nice bullish candle, exceeded the high, which we spoke about the fact that possibly, again, kept a number of market participants psychologically unawares of what could be possibly playing out. Of course, news headlines and geopolitical murmurings do affect sentiment and affects it very quickly. And so we were positioned for this drop, but not nearly with the speed, momentum, and magnitude in which it came. So today, keep it simple, smarty. We are facing price action that many of you may not have seen. If you started trading within the last 4 years, you have not seen this price action before. And it is important to preserve all forms of capital. Mental, emotional, and financial capital needs to be preserved today. It is actually a very good environment for you to sit out and look on as to what takes place so that for future reference, you can position yourself now that you've lived through the emotions of it, you've lived through the mental perspective of seeing price action being affected by the news being affected by the price action, that you're better able to handle it next time if you are new to the market. If you do have some experience and if you are an experienced trader, then of course, by all means, you will be looking for reactionary lows this morning. you will be looking for something, some level to trade against. So let's see if we can spot a couple of those. Now, again, we're on the weekly chart, and I actually had this level here from years ago, going back to the middle of 2019, extending all the way back into 2018. We have this level here at around a low of 2767, 2770, you could say. And it's a fairly, not wide range, but between that 2799 and 2767, possibly we can see some signs of buying come in. However, I would definitely wait to see that shift, or that impetus, or that impulse to the upside, that then gives me a clearly defined level to trade against. Why? Because anything is possible. We can see 2600 on the S&P. Anything is possible, but we must plan for what is probable and using the market generated feedback that we are getting in real time. So if we do have something to trade against, then by all means define your risk, set your stops mentally or otherwise, and look for possibly bounces into upside levels. Last week's close we had up here at 29.65. That can be a possible target for against any reactionary low. You also have the underside of where we came to just about a week and a half ago, this low here at 28.53. So that's two levels to the upside that we can possibly target today. To the downside, again, we have, now that we're at 28.19, I would expect probably a push into that round number 2800 very early in a trading session. Look to see how 2800 responds. If it does not bring in any sort of aggressive demand, we have a very weak sort of limp bounce, then that might be an opportunity to position short once again against 28.19, looking for 27.65. Not necessarily in today's trading session, but in the ensuing days as price action unfolds. Keep it simple, smarty. We are just about we're just about 25% into the year. I don't know how you have been trading, the gains that you've made, the knowledge that you've had, but do not at this point be too brash in terms of your positioning and blow it all up, lose it all, or put yourself into a mental position where you're on the defensive and you're not able to take advantage of price action that will come in the future. Because of how volatile the environment is, you can actually use smaller size and have magnitude of gains and or losses equivalent to what you would have probably been using before, simply because the ranges have expanded so much. And so definitely my advice, my counsel is reduce your position size. If you are going to put yourself at risk in this environment, reduce your position size so that you are comfortable with the risk, the defined risk that you are taking, and then allow the market to go through the process of price discovery, go through the process of trending one way or the other, and you simply surf the market momentum in that direction, being sure to take targets, because especially in volatile environments like these, once levels are found, once buying or selling comes in against a level, it trends in one direction until it reaches another level. And so if you hit a level, be sure to take in profits, because very quickly it can reverse and begin price discovery in the other direction until it reaches the extreme of its level in the other direction. Be safe out there today. Cheers.